In this module, we're going to talk about order types. We've spoken about buy trades and sell trades before, but let's talk about orders in more detail. So the first order type is known as an instant market execution order. So let's say this is the market and the current market price is so. When you enter a buy or sell trade using an instant execution order, you're going to enter the market at the instant market price. So if you was to do a buy trade, you'd get in looking for the market to go above your entry, or if you choose to do a sell trade, you'd be getting in looking for the market to go below your entry. Now there's other types of orders where instead of getting in at the instant price, you can get in at a future price. This is known as a limit order. For example, if the market price was so, and we believe that the market is going to go to the upside, however, we wanted to do a sell trade at a higher price, we could put in a sell limit. So you can put in a sell limit, and when the market reaches that price, you're going to enter into a sell trade automatically without you having to be there on the chart. Likewise, if you was to do a buy limit, that means you're going to do a buy at a lower price. When the market reaches that future price, it's going to put you in to a buy trade automatically. Now this is really helpful for those of you who, for example, are busy on your day-to-day activities and you don't have time to watch the market, but you've done some analysis, you have a bit of intuition that the market's going to go back to its high and then go down. Therefore, you could put in a sell limit. Then you have the peace of mind knowing that if the price reaches that price, it's going to execute the trade for you. And likewise with a buy limit, when the price gets to that buy limit, it will execute a buy trade for you. Now let's say you expect the market to go up, however, you don't want to enter a sell trade. You actually want to enter a buy trade at a higher price in the future. Therefore, you wouldn't be using a buy limit, because buy limits you can only place below the current market price. You would, however, use what's called a buy stop order, a stop order. Okay? So a buy stop simply means rather than the sell limit selling you at a higher price, the buy stop will buy at a higher price. So when the market gets to that price, you would enter a buy trade in hopes it's going to carry on to the upside. And likewise, a sell stop, you would place a sell stop below your market price. When the market reaches the sell stop, it will enter you in a sell trade. Now, this might get a bit complicated to put your head around. However, it's good to put it into practice on the charts using a small size trade just to experiment so you can understand exactly which stop works in which direction. Now, the other tools at your disposal are what's called a stop loss and a take profit. You may have heard of these terms before, but let's go over it in a little more detail. A stop loss is simply, as the name suggests, it limits your loss from being greater than it could be. For example, let's say we entered a buy trade. However, the market didn't go up, it went against you, it went to the downside. Your trade would not close automatically unless you had placed a stop loss. If you had placed a stop loss 30 pips or 40 pips below, if your trade was to reach that price of negative 40 pips, it will automatically exit you out of the trade without you having to be there. So it's a safety net that you should always get into the habit of having stop losses. Likewise with a take profit, if you had a correct trade and it went in your direction, Again, you need to understand when to exit your trades, which is part of analysis. And when you identify where you can exit your trade, you could put a take profit to automatically take you out of that trade.